Unmute na to the. Yeah, audible?
Yes.
I welcome you all to this webinar hosted by Tax Friends on financial statements of non-corporate entities by CA Kamal Garg from New Delhi. This idea was conceptualized by our past president Vijay Keval. Because of need of an hour, this message was running around WhatsApp community all over. The need of this topic was actually required. Hence, this webinar is being organized. So without wasting much of the time, I will take the pleasure of introducing our speaker. If I speak about his profile, then it will take more than half of the time of this webinar. So I'll just briefly introduce him. CA Kamal Garg. He is qualified chartered accountant. He is accomplished chartered accountant, renowned figure in the Indian accounting, auditing, corporate law landscape. He is a fellow member of the Institute of Chartered Accountants and holds first class commerce degree from Deen Dayal Upadhyay College, University of Delhi. He also holds master's degree in commerce and has undertaken several advanced certification, including post-qualification courses like Diploma in Information System Audit from ICAI, Certificate in Business Responsibility and Sustainability Reporting from ICAI, Social Auditor Certification from NISM, certification courses on ODR, that's Online Dispute Resolution, Social Listing, and Municipal Bonds from NISM. He is registered insolvency professional with Insolvency and Bankruptcy Board of India, that is IBBI. Kamal Garg has served in several high-level committee and task force within ICAI and other institutions. That is Board of Studies, North NIRC of ICAI, Study Material Research Group from 2009 to 2010. In Accounting Standard Board of ICAI, he was a special invitee from 2012 to 2013, then again 2021 and 25-26. Financial Reporting Review Group of ICAI, and IFRS Implementation Committee of ICAI, Committee on Banking and Insurance and Pension of NIRC of ICAI, Peer Review Board, Ethical Standard Board, and other ICAI committee. He was a resource person of all these committees. The Committee on Economic, Commercial Law, and Economic Advisory, Corporate Law and Governance Committee, Committee on Financial Market and Investor Protection, Auditing and Assurance Standard Board of ICAI. He was expert panel member of all audit-related queries. He's also contributed to training program for CBI inspector in insolvency laws. Guest speaker for National Board of Accountant and Auditor in Tanzania. Indian Institute of Insolvency Professional of ICAI. He has also contributed to study and regulatory projects. Nominated member of PRPC, Task Force on Guide to Competition Act 2002 by the Institute of Company Secretaries of India. Gargji is prolific author and he has authored more than 30 books and practical guides covering the wide spectrum of the topic in finance, law, auditing. His work widely used as professional students and regulatory authorities. The key title are many, I will name few. IFRS and Ind AS, Audit Trail, COVID-19, Guide to Financial Reporting, Concise Commentary on Companies Act, Red Flag Compendium, Borrowing Loans and Investment by Companies, NFRA, Law and Practice, Standard on Auditing, Practitioner's Guide, Concise Commentary on Insolvency and Bankruptcy Code, PMLA, Handbook on Reporting Entities, Guide to Tax Audit under 44AB, CARO 2016 and 2020, Handbook on Internal Auditing, and among many other books. His work are published by the reputed legal publishers such as Bharat Law House and Walter Kolz, his international publisher. He has also contributed significant content such as Gist of Accounting Standard for Company Law publication, numerous articles in ICA newsletter, NRC, CRC on the topic like FBT, MAT, CARO, FEMA, USOX. Detailed article in tax and corporate reference on DVAT, ECB, direct tax and foreign investment. His area of expertise, he is a deep practical and academic expertise in corporate law, audit and assurance, taxation, direct and indirect tax, insolvency and bankruptcy, his advisory, training and regulatory consultation, financial reporting, IFRS, NDS, consolidation, interim reporting, Schedule 3, sustainability and compliance, ESG, BRSR, social audit. He's a regular guest speaker and trainer at ICAI and ICS and other national and international forums. He's delivered the lecture and management development program on IFRS, auditing standard, insolvency law, corporate law, and related topic. He is invited by regulatory enforcement like CBI for capacity building in specialized financial and legal areas. CA Kamal Garg stand out as a highly respected professional with a strong academic foundation, wide-ranging subject matter expertise, and an impressive record of contribution to the professional education, law, and policy development, and institutional strengthening in India and abroad. His multifaceted role as a thought leader, educator, author, and a practitioner make him prominent and influential figure in the field of accountancy, corporate regulation, and insolvency law. With this, I present before you CA Kamal Garg.
Vijay, for such a warm welcome, and it's really pleasure to be with you all, and good evening to all of you. I'm thankful to Vijayji also for giving me this opportunity to address this gathering. And before I share my screen and discuss topic in detail, let me ask you a few questions. Question number one, which I would request you do not search on Google or ChatGPT, try to answer on your own. Question number one, the topic given to me is financial statements of non-corporate entities. Very recently, Institute of Chartered Accountants of India has issued guidance note on financial statements of non-corporate entities. And hence the question is, on whom this guidance note on financial statements of non-corporate entities is mandatory. I emphasize the word mandatory. Who is duty bound to comply with this guidance note? And not only who is duty bound to comply, when he is duty bound to comply. So one is the mandatory applicability, and second is when we come to the applicability part, the question arises when it is applicable. So it is not only on whom it is applicable, it is also when it is applicable. There is a misconception traveling into the minds of our professionals that it is mandatory even for the client. No, it is not like that. Another misconception which is traveling into the minds of chartered accountants primarily is that it is mandatory only when they discharge audit function like tax audit. So people do say that if I am the tax auditor of a partnership firm and partnership firm primarily is NCE, non-corporate entity, then they do say during the course of tax audit, we have to comply with this guidance note. It is not like that. It is only for the members to comply that I can agree. But when and in which function that we need to understand. So we'll discuss that aspect in detail with some of the case studies also. As far as PPT is concerned, immediately after this event, I will send this PPT to Vijayji, then he may circulate further. The second area of my discussion, in addition to this guidance note, would be another important aspect, applicability of accounting standards. You may respond in the chat box, how many of you are aware that guidance note that the applicability of accounting standards has undergone a change? You may recall on 8th November 2024, the Council of Institute of Chartered Accountants of India has given a revised criteria for applicability of accounting standards on non-corporate entities. Earlier, there used to be four classifications: level 1 enterprise, level 2 enterprise, level 3 enterprise, and level 4 enterprise. This level 1, level 2, level 3, level 4 is no longer applicable. As on date, we do have only two classifications: large enterprises and MSME enterprises. And why we need to understand this thing? Guidance note on financial statements of non-corporate entities merely deals with the presentation requirements. It is not dealing with the accounting requirements. Accounting requirements are dealt by the accounting standards. So we must also understand which AS is applicable to which of the entity. Several exemptions have come in. So we'll discuss those exemptions also, along with the applicability of accounting standards. It is quite unfortunate if I say through this platform, it is quite unfortunate that when I visit the social media, even today, many people are posting a wrong content on social media. On social media, it is very popular nowadays. The content is traveling like level 1, level 2, level 3, level 4 enterprises. No, it is not like that. From financial year 24-25 onwards, this classification is no longer relevant. The relevance is now only two-way, MSME and large enterprise. So we will discuss these things also. To give a brief highlight, suppose that your non-corporate entity falls into the MSME criteria. Now, if your non-corporate entity, like say you have a partnership firm as your client. Now, if this client partnership firm falls into MSME category, no need to compute deferred tax. This exemption has come in. I repeat, if your client is partnership firm and CE and it falls into the MSME category, no need to compute deferred tax. And what we will do for the deferred tax, which we computed earlier, that we'll discuss in detail once I will move forward. More importantly, third segment of my discussion, you may recall it is quite customary practice that in the books of accounts of non-corporate entities, the clients are providing depreciation as per section 32 of the Income Tax Act. But what is the right scenario? The right scenario is in the books of accounts, the depreciation shall be provided as per the useful life of the assets. Now, what is happening? Rather than providing depreciation on the basis of useful life, the depreciation in the books is as per section number 32 of Income Tax Act. It's a contravention. I must emphasize it's a contravention. And if you are the tax auditor of such non-corporate entity, then in clause number 13 of Form 3CD, you have to give a reconciliation and hence the qualification in Form 3CB. And what is the qualification? The qualification is that depreciation in the books of accounts is in contravention of Accounting Standard 10, but people are not doing it. So how to overcome this kind of a scenario and how to qualify, I will discuss that thing in detail as well. So with these setting the tone words, I am sharing my screen and I will discuss each aspect in detail. Vijayji, kindly confirm once my screen is visible. Is it visible, Vijayji?
Yes, starting. It's not yet started. It's just showing started screen. Yeah, now it's visible.
Okay. So ladies and gentlemen, this is my topic, financial statements of non-corporate entities. I will divide my discussion into two broad segments. So one is the guidance note on financial statements of non-corporate entities and second is the applicability of accounting standards, because both are these amendments culture for the financial year 24-25. Let me go to the historical background. So how this whole agenda started. In 2022, Institute of Chartered Accountants of India issued a technical guide. If you see the picture on left-hand side, this picture on left-hand side, which is titled as Financial Statements of Non-Corporate Entities, it is a technical guide. This technical guide was issued in year 2022, and it was recommendatory those days. Now what happened? The things progressed, and year 2023, Institute of Chartered Accountants of India came up with another publication, which is titled as, you can see the right-hand side picture, Guidance Note on Financial Statements of Non-Corporate Entities. And this guidance note on financial statements of non-corporate entities superseded the technical guide. So as on date, what is the scenario? The publication which is relevant for us is Guidance Note on Financial Statements of Non-Corporate Entities. And this is mandatory in nature. Now the question arises, to whom it is mandatory? We will discuss in a while. Please also underscore my words. This Guidance Note on Financial Statements of Non-Corporate Entities is applicable for the first time. I emphasize, is applicable for the first time for the financial year 24-25. So if you have non-corporate clients like proprietorship firms, like partnership firms, like societies, and so on, like HUF and so on, in such a case, these will be classified as non-corporate entities, and for their financial statements, what you have to follow is Guidance Note on Financial Statements of Non-Corporate Entities. But the question arises, who has to follow? Who has to follow? If we say it is mandatory, to whom it is mandatory? So it is mandatory. Now be careful what I'm saying. Be very concentrative. The compliance of guidance note on financial statements of non-corporate entities is mandatory for each CA in practice who is discharging attestation function. I repeat the words attestation functions. Meaning thereby, let us take two examples. Example number one, suppose that one of your client is partnership firm and tax audit is applicable upon such partnership firm. Now, because you will be discharging your attestation function in your capacity as tax auditor of this partnership firm, you have to ensure, you have to check whether this partnership firm has prepared and presented its financial statements as per the guidance note. If partnership firm has not complied with this guidance note, then you have no other option but to qualify the tax audit report in Form 3CB. How to qualify? I will show you a sample paragraph after some time. Now, what is the agenda coming up? The agenda coming up is the partnership firm will say, why should I comply? And for this question, the partnership firm is right, because Chartered Accountants Act is not applicable upon the partnership firm. So partnership firm may stand on adamancy side and they may say we will not comply. And if it is not complying, then you have to qualify your report. Because if you will not qualify, it will result in professional misconduct under Chartered Accountants Act. How to qualify, we will see in a while. So what is the liner coming up? The liner coming up is the compliance of guidance note on financial statements of non-corporate entities is mandatory to whom? It is mandatory only to chartered accountants in practice whenever they discharge their attestation function. Let me take second example. There's a partnership firm and the partnership firm is not covered by any tax audit or any attestation requirement. And then the partnership firm says, please prepare my financial statements. Then it is your choice what format you want to follow. So long as there is no attestation involved, no need to comply with the guidance note. But when attestation functions are being discharged by you as a practitioner, then you have to ensure that this guidance note is followed. If it is not so followed, then it will result in professional misconduct. I must invite your attention to the Code of Ethics. Code of Ethics 2020 edition. Now, Code of Ethics 2020 edition, you may just focus on the screen these highlighted words. Now, there are two publications. One is technical guide and second is guidance note. As far as guidance note is concerned, guidance note always have the authority of the council, and that's why it is mandatory. Whereas when we say technical guide is not having any authority of the council, and that's why technical guides are recommendatory in nature. So you may be aware that we have technical guide for NPO, non-profit organizations. These contents in the technical guides or NPO are not mandatory in nature. Why? Because Code of Ethics says, just see the last words, technical guides have no authority of the council attached to them. So technical guides are recommendatory. Even if you are not complying with the technical guide, no question of professional misconduct. But guidance notes are mandatory in nature. So if guidance notes are not complied and you're not qualifying for that purpose, it will be a professional misconduct. Now, when we say guidance note on financial statements of non-corporate entities, so guidance note on financial statements of non-corporate entities deals with four aspects: preparation and presentation format for balance sheet, preparation and presentation format of statement of P&L, related notes, and the general instructions. We will see them separately one by one. Now, I have two questions for the house. Question number one, in case of the trust, whether statement of P&L is required or any other statement is required. And question number second is, in case of the trust, receipts and payment statements is also prepared. Whether this guidance note also covers with such statement. Yes, any answers? So what are your answers for question number one and question number second? So you may take a note. The guidance note itself says that in case of trust, etc., the statement of P&L can be suitably renamed as statement of income and expenditure, meaning thereby the guidelines contained in this guidance note are equally applicable in mutatis mutandis manner even to income and expenditure account. The income and expenditure account is prepared in case of trust, and in that very sense, you can simply change this name of statement of P&L to statement of income and expenditure. More importantly, in case of trusts and NGOs, there is a practice of preparing receipts and payment statement also. Please underscore my words. This guidance note is not applicable to receipts and payment statements. So even if you are preparing receipts and payment statements, there is nothing written in the guidance note for that aspect. And more importantly, guidance note is dealing only with balance sheet and P&L. Guidance note is not dealing with cash flow statement. Guidance note is not dealing with the cash flow statement. So please be careful. Guidance note deals only with balance sheet, statement of P&L or statement of income and expenditure, related notes, general instructions. So what is the conclusion coming up? Guidance note is not dealing with the formats of cash flow statement or the receipts and payment statement. I believe this aspect is clear to each one of you. Should you have any query, you may type in the chat box. Moving another way. Now, why this guidance note was required? The guidance note was required for a very big reason. The reason was, while we have accounting standards to deal with the principles of recognition and measurement, to deal with what needs to be debited, what needs to be credited, but accounting standards are altogether silent as to what shall be the presentation requirements, formats for financial statements. So each individual, each entity was adopting its own way of presenting the financial statements, and there was no uniformity. To bring in that uniformity, efforts were made first by way of technical guide, which was recommendatory in nature, and then this guidance note. And this guidance note was made mandatory for the financial statements which are covered by the period beginning on or after 1st April 2024. So if I read it for you, while recognition and measurement principles laid down in the accounting standards issued by ICI are applicable to non-corporate entities, and certain disclosures and presentation aspects have also been dealt with under the accounting standards, formats for the presentation of financial statements of NCEs have not been prescribed. So no formats were there. So with this very vision, Accounting Standard Board of ICI has now prescribed the formats for preparation of financial statements for NCEs in the form of guidance note on financial statements of non-corporate entities, and which is effective for the financial statements covering periods beginning on or after 1st April 2024. Now, what is the meaning of NCE? The guidance note says NCE shall comprise of all business or professional entities other than companies incorporated under the Companies Act, and LLPs incorporated under LLP Act are considered to be NCE. So basically, proprietorship firm, partnership firms, HUF societies, they will be covered by this guidance note as NCEs. And what you need to understand always and always, when you prepare the financial statements as per these formats, you have to give the comparative figures also. And these comparative figures are not required if entity is entirely new entity. So if there was no existence of the entity in the preceding year, obviously no comparative information is also required. I must also highlight one point again. Please underscore these words. The guidance note deals with the formats. Nothing has undergone a change about the accounting requirements. The way you were doing accounting earlier, I repeat, the way you were doing accounting earlier in compliance of the accounting standards, the same way will propel in this year also, next year also. What has undergone a change is only the presentation. So presentation formats are now laid down, and these presentation formats have not changed any of the accounting requirement contained in the accounting standards. I believe this point is clear to each one of you. With this very background, let me ask you a few questions. This is the question number 1. Please try to answer this question in the chat box. R & Sons HUF was subjected to tax audit for the financial year 23-24, but due to some unforeseen circumstances, the tax audit was delayed, and the tax audit report was issued by the CAX on, say, 5th April 2025. Now, question is whether CAX needs to ensure that R & Sons HUF should have followed the guidance note on financial statements for non-corporate entities. Yes, what's your answer? So in this question, whether guidance note on financial statements needs to be followed or not. Answer is no. Why the answer is no? Because the financial year is 23-24. Although the report is signed on 5th April 2025, but we need not see when the report is signed. We have to see which financial year is involved. Here the financial year is 23-24. That is a year which is prior to 24-25. So in this very case, the answer will be no need to comply with the guidance. That is the answer. Now let me move forward. So guidance note very categorically says that there can be certain circumstances where the formats for financial statements are prescribed specifically by any relevant legislative statute requirement or any other authority. For example, formats have been prescribed for trust under Maharashtra Public Trust Rules 1951. So if the formats are prescribed by any legislative piece, then this guidance note is not relevant because the law will prevail over the guidance note. So let me read this for you. This guidance note is relevant for the purpose of preparation of financial statements of above mentioned NCEs unless any formats or principles are specifically laid down or prescribed by the relevant statute or regulator or any authority. For example, formats have been prescribed for trust under Maharashtra Public Trust Rules 1951. Similarly, autonomous bodies under the Government of India are required to compile their accounts in a uniform format of accounts as prescribed by Government of India. So wherever any law prescribes the format, you have to follow those formats. Else you have to follow this guidance note. That is what this principle says in the guidance note. Now, as I already covered, let me, for the sake of repetition and reinforcement, let me again tell you this thing. By virtue of Code of Ethics, Volume 2nd, 2020 edition, 2 things must be kept in mind always and always. I already covered, so I will not invest much time to repeat, but for the sake of recapitulation, I must tell you, number 1, As per Code of Ethics 2020 edition, compliance of guidance note is mandatory because guidance notes do have the authority of the Council of ICI, whereas compliance of technical guide is not mandatory. Technical guides are recommendatory in nature because it do not have any authority of the Council of ICI. If guidance notes are not followed, then it will be a professional misconduct under clause number 9. You can see the laser pointer at the bottom of this clip, clause number 9 of part 1 of second schedule. So if guidance notes are not followed by a CN practice, it will result in professional misconduct. So I put a question before the house: for whom compliance of guidance note is mandatory? The CN practice or the client, that is NC? What is the answer? So Sunilji, your answer is correct. The correct answer is CN practice. So it is applicable for CN practice, not for the client. Now let me put some more questions before the house. Before I come, just see the questions are: question number 1. I have skipped 2 clips. I will come to those clips in a while. Let me first cover the questions. Question number 1. RSTN company partnership firm wished to raise loan from Punjab National Bank (PNB) for its expansion activities. The bank has required the firm to submit its financial statements for the year ending on 31st March 2025, duly attested by CN practice. Tax audit is not applicable on this partnership firm. Now, question number 1 is whether this guidance note needs to be complied by the firm, and question number 2, whether this guidance note needs to be ensured as to complies by CN practice. Please be careful. The question is saying tax audit is not applicable on this partnership firm. So whether this guidance note is required to be complied, answer is yes. Why the answer is yes? This guidance note compliance is required because attestation services are being rendered by CN practice. But now the question is, who will comply this guidance note? The CN practice will ensure that my client has complied with the guidance note. If the client will not comply, then you will qualify the attestation report. So wherever attestation is involved, you have to ensure that this guidance note is complied. And please understand, not all the attestations are covered. Only those attestations are covered where attestation of financial statements are involved. Where attestation of financial statements are involved. Question number 2. RSTN company partnership firm wish to obtain state subsidy for its expansion activities. The state government required the firm to submit its financial statements for last 5 years, including the year ending on 31st March 2025, duly attested by ACN practice. Tax audit is not applicable on this partnership firm through all these years. Question number 1, whether this guidance note needs to be complied by the firm, and question number 2, whether this guidance note needs to be ensured as to compliance by CA in practice. Yes, what's your answer? So question number 1 is, this is not mandatory on the firm to comply. So firm may always say, why should I comply? Because chartered accountant sector guidance notes are not applicable upon me. But it is indirectly being made mandatory through CN practice. So CN practice needs to ensure that this guidance note is being complied by the firm. If firm is not complying, then what you will do, you will qualify your report. Why you will qualify? Because you will qualify because here again you are rendering attestation services. Now, because attestation services are involved, quite obviously you will ensure that this guidance note is complied. But what is the main point in this question in addition to these 2 questions? They say you have to give last 5 years report. And this last 5 year will include even the year 24-25. So this guidance note is applicable for the year 24-25. So you will prepare the format as per guidance note. Now, because 24-25 is involved, guidance note says you have to give comparative figures also. So for the year 23-24, comparative figures also will be given. Now it is your choice that for the last other 3 years, whether you wish to give the format figures or your own format figures. To my personal wisdom, I believe most of the cases people will give this format of the guidance note. Otherwise, it is not mandatory. It's your choice for the first 3 years. It is your choice to give the new format or the old format. But it would be quite chaotic and it would be quite hodgepodge if first 3 years are as per old format and next 2 years are as per the new format. So it is totally your wisdom, totally your choice. But yes, new format is required for financial year 24-25. So wherever attestation is involved, for financial statements, you have to ensure that the client complies with the guidance note. If the client is not complying with this guidance note, then quite obviously you have to qualify your report. Now, let me go back to the clips which I skipped. I must draw your attention to para number 10.2 of guidance note on tax audit. So this guidance note on tax audit is also needs to be highlighted over here. Why? Because tax audit season is approaching. And this tax audit guidance note stated very categorically. Let me read these highlighted words. In case of certain assessees, law does not prescribe any specific format or requirements for preparation and presentation of financial statements. Now, this guidance note means the guidance note on financial statements of non-corporate entities. The guidance note on tax audit also has highlighted the importance of this guidance note with the words, this guidance note is effective for the financial statements covering periods beginning on or after 1st April 2024, and from that date, the technical guide on financial statements of NCE will be superseded. So now, even tax audit guidance note is making it very clear, and that too in very explicit and expressive words, that you have to comply with this guidance note. And that's why I told you in the very beginning, during the course of tax audit of a non-corporate entity, if this guidance note is not followed by the NC, you have to qualify. Where you will qualify? You will qualify in Form 3CB, para number 5. How you will qualify? I will show you a sample paragraph, and you may use it in your day-to-day working as well. So what is the conclusion up till here? The conclusion up till here is just like this. Just give me a moment. This is the conclusion. This is the bird's eye view of whatever I discussed till now. Guidance note on financial statements of non-corporate entity is mandatory for financial year 24-25 onwards. And when mandatory? It is mandatory when such NCE is under any attestation requirement by practicing CA with respect to its financial statements, for example, tax audit. What if guidance note is not complied? If guidance note is not complied, then primarily there are two stakeholders. One is the auditor or the attestator, and second is the auditee or the attestee. So what the scenario becomes, practicing CA needs to qualify his report, else guilty of professional misconduct. And as far as NCE is concerned, no contravention per se, because Chartered Accountants Act is not applicable on such NCE. So I will give you 30-40 seconds over here on applicability area. If you have any questions, I would be happy to answer your queries in the chat box. Because immediately after this discussion, I will move to the formats as given by guidance note. So up till now, if you have any query on the applicability or any confusion or a dilemma about applicability, I would be happy to answer. There's a question by Sunil Ramji. What about cooperative society? So Sunil Ramji, cooperative society is a non-corporate entity for the purpose of this guidance note. And if I assume that no statutory format is given by the state law for the cooperative society, in such a case, what will happen? You have to follow this guidance note. Like if I take an example, we have Multi-State Cooperative Societies Act. Now, in case of Multi-State Cooperative Societies Act, there is no such kind of a format. So in that very sense, we will comply with this guidance note. There is a question by Vijayji, what about trust in Maharashtra? So Vijayji, I already covered this aspect. Let me again show you the same on screen. Just see over here. So formats have been prescribed under Maharashtra Public Trust Rules. So in such a case, this guidance note will not be applicable because these rules will override this guidance note. Am I clear, Vijayji? There is a question by Sunilji, association of persons having business, will it be applicable? Answer is yes. AOP is NCE and then it will be applicable. There's a question by Arunji, if a partnership firm do not have tax audit but need to certify for bank loan, then in that case, will we a CA attestation? Answer is yes. So when a firm approaches you that it wants to avail the loan and it requests you to certify the financial statements, then obviously, yes, this guidance note is required. I covered this illustration also for this purpose. So this is question number 1, Arunji, quite similar to what you are asking. So in that very sense, this guidance note compliance is required because you are going to render attestation services. So let me move forward. So these are the general instructions of this guidance note. Now what this guidance note says, relevant applicable accounting standards or statutes with respect to financial statements will override the formats given by guidance note. So it's quite obvious, accounting standards will prevail over this guidance note format, or relevant law will override the requirements of this guidance note. Now what they say, the disclosure requirements as given by the guidance note are not in substitution of the requirements given by the accounting standards. So meaning thereby, if guidance note asks you to disclose something, and accounting standards are also asking you to disclose some more things, then what will happen? They will go hand in hand. So it is not like that you will simply ignore the accounting standards. So guidance note requirements and accounting standards requirements for disclosure will go hand in hand. And each item of balance sheet and P&L shall be cross-referenced, like we do in Schedule 3 also. Like in Schedule 3, we write equity share capital, note number 1, loans, note number 2. Same way, you will do the cross-referencing here. This fourth bullet point is very important and very significant. What this guidance note says, balance shall be maintained between providing excessive details that may not be useful for the use for financial statements and not providing relevant information. Meaning thereby, what is the meaning of this sentence? In the format, there can be certain line items which are not applicable to your NCE. No need to write those line items. You can simply remove them because otherwise it will result in excessive details. So it is your professional judgment, it is your professional wisdom. If you feel that certain requirements given by the format are resulting in excession or excessive details, you can simply remove them. That is what the benefit of the sentence is. There is a question in the chat box. Receipts and payments account be an additional statement to financial statements of trust. Yes, it is a very correct statement. The guidance note is not dealing with the receipts and payment statement. So it will be in addition to what your own requirement. It is not the requirement of guidance note. There is again a question by Vijayji. When society accounts are made and certified by cooperative auditors, non-C and Maharashtra, what will be the position? So in that very case, this guidance note will not be bounding upon them. Why? Because this guidance note is meant only for members of IC and practice. So if an individual is not a member of IC and practice, then this guidance note has no relevance for that individual. Am I clear, Vijayji? Let me proceed further. Just take up this question. RS and Company Partnership Firm has submitted the following information. Sundry debtors total rupees 5 lakhs and sundry creditors total rupees 3 lakhs. And this 5 lakh and this 3 lakhs respectively comprises of these parties. Action Company ABC LLP, Mr. Y, Sons HUF, and similarly for creditors, DEF Private Limited, LMN LLP, Mr. Z, R Sons HUF. So it is a kind of customary practice, especially in non-corporate entities, that in the balance sheet they will give the total amount of debtors and creditors, and then they will give the breakup of the debtor and creditors as annexure A, annexure B. Now, question arises whether this guidance note is requiring to give the breakup of various parties involved in debtors total and creditors total, whether this kind of breakup is required. Answer is no. Answer is no. So now if you want to give this breakup, it is totally your choice. But this guidance note is not requiring you to give the breakup of all the parties. So it is entirely up to your choice whether you wish to give this breakup or not as a matter of annexure to the total of debtors or creditors. I believe this point is clear. There is a question by Shankarji. How can the CA assess what is excess of user and each users need to be maybe different? Shankarji, your question itself is giving the right answer. So it will depend upon case-to-case basis to decide upon whether it is excessive detail or whether it is required detail. So depending upon the stakeholders involved, you have to take a call whether this information is excessive or this information is required. For example, if you see this question number 3 on the screen, some NCEs may say that the breakup of debtors and creditors is required for my banking purposes, and you need to attest the same. So in such a case, it will not be called as excessive detail. So depending upon case-to-case basis, it will require some effort to take a call, to take a decision whether the information being given in the format will be turning out to be excessive or will turn out to be indispensable. There is a question whether details are part of schedule or grouping. So details are not the part of schedule because the guidance note is not telling you to give this breakup. So ultimately, guidance note requires in the format only this amount, sundry debtors or sundry creditors. Total amount needs to be given. So it will be a part of macro level grouping, not granular level breakup. So once I will move forward with the format, you will find the format for these items also. Now, so now guidance note says rounding off. Now rounding off is not mandatory. It is recommendatory or it is quite optional because the word is may. So guidance note says depending upon total income of non-corporate entities, the figures may be rounded off. The word is maybe. So whether you wish to round it off or you wish to avoid rounding off, it is totally your choice. But if you are deciding to round it off, then this slab will be based upon total income. So total income words are used. It will include sales from operating activities as well as non-operating income. So if the total income is less than rupees 100 crores, total income is less than rupees 100 crores, then the rounding of level will be to the nearest hundreds, thousands, lakhs, millions, or crores thereof. Whereas if the total income is 100 crores or more, then rounding off is nearest lakhs, millions, or crores thereof. If you see very carefully, the rounding of level of hundreds and thousands, it gets missing in the second slab. So the very moment total income touch 100 crores or more, you are not allowed to round off into hundreds and thousands. To make this thing understandable, let me give you a question. For the financial year 2425, the NCE partnership firm decided to adopt rounding off. So now the NCE client says, I will round it off my figures. Now what happened? For financial year 2324, the total income was 90 crores. And for financial year 2425, the total income is 102 crores. Now question rises, how you will round off? So last year it was total income of 90 crores. And this year it is total income of 102 crores. Guidance note is applicable from 2425. And guidance note says you have to give comparative figures also. So what will be the level of rounding off? The level of rounding off will be guided by current year figures. So because it is 102 crores, the rounding off will be in the levels of next lakhs, millions, or crores thereof. Now, please understand, do not commit this mistake. Last year, the question says that last year total income was 90 crores. So please do not round off last year figures in hundreds or thousands, because rounding off is guided by current year figures. So meaning thereby, even in the comparative year, you will have the consistent rounding of policy, either lakhs, millions, or crores thereof. I believe this point is clear to each one of you. So what is the learning? The learning is rounding off of the figures will be guided by current year total income, not the last year income. And you need to follow this rounding off consistently. Now let me move forward. Now the guidance note says that you have to take total income as a matter of slab to decide level of rounding off. So I need to ask you a question. Which of the following shall be considered for computing total income? So if you wish to compute total income, you have serial number 1 to serial number 8. Total 8 items are given. So please tell me which of the items will be considered for computing total income, or I should change my question. Which of the items will not be considered? So shall we consider all, or we need to exclude some of the items for computing total income? And I must again remind you with emphasis, the words are total income. Let me check the answers. 6 to 8, okay. Answer given by Hariji is correct. All items will be included, because the words are total income, not total revenue. So we will add up, we will aggregate all the items, and quite obviously there are sales returns, so it will be a negative item. So item number 1 plus 2 and so on, we will aggregate all the items and net effect will come up. So total income will comprise of all these items. There is a question, let me read it. Additional disclosures can suo motu be given over and above guidance note requirement? The answer is yes. And you can give additional disclosures of your choice, whatever you want. And there will be absolutely no contravention. So guidance note gives you minimum disclosure requirements. Extra, you can go to any extent you want, provided there is no breach of confidentiality. There is a question, 6 months debtors and creditors may con. So for this 6 months debtors and creditors, we have to wait for a while, because this item will come up during the course of my deliberation. For Arvindji, who is watching on YouTube, please wait for a while, because this investments breakup will also come up in my deliberation. So let me move forward step by step so that each item will come up gradually. Now, the general instructions further say, once a unit of measurement is used, it should be used uniformly. How and when it will be used, we will see in a while. I already covered this thing. Comparatives needs to be given unless and until it is a new entity. And lastly, for the purpose of this format, the terms used herein shall be as per the accounting standard. So whatever words are used in the guidance note, this definition will be guided by the accounting standard. For example, the guidance note uses the words related parties, but guidance note is not defining who is RP. So for this purpose, we have to go to the accounting standard, that is AS 18. Now on this, once a unit of measurement is used, let us have a discussion. See this question. RS and Company partnership firm makes domestics as well as export sales. The domestic sales are invoiced in INR and the export sales are invoiced in USD. In the profit and loss statement, the export sales are accounted and presented after applying AS 11. AS 11 deals with translation of foreign differences. and reporting currency hence is INR. In the notes to accounts, the firm reported that export sales for the current year are USD so and so, and for the preceding year it was USD so and so. The question is it the correct way of disclosure? Answer is no. Guidance note says that you have to use one unit of account on uniform basis. So now what is happening in the P&L, you are reporting in on INR basis, but in notes to accounts you are reporting on USD basis. So this is inconsistency. This inconsistency is not allowed. So what you have to do, even in the notes to accounts, you have to mention equivalent INR. So this INR in P&L should match with this notes to accounts, and that's what this line says. Once a unit of measurement is used, it should be used uniformly in the financial statement. So that's why the answer is INR equivalent, cross reference with P&L also required. Now let us come to the format of balance sheet. You will find that format is more or less similar to the formats given by Schedule 3. But I must say I use the words more or less similar. There are some differences also. Let us see these things gradually. This is the format of balance sheet. So you will give name of the non-corporate entity, then the balance sheet as at 31st March 2025. Just see this rupees in. This is nothing but level of rounding off. So rupees in lakhs or millions or crores or thousands as the slab is applicable to you. Then the particulars, note number, figures as at the end of current period, that is 31st March 2025, and figures as at the end of previous reporting period, that is 31st March 2024. It is more or less the same bracket look as we see in Schedule 3. Now just see here. First heading is equity and liabilities. It comprises of owner's fund, and for owner's funds, we have to give a breakup of owner's capital account and reserves and surplus. I would request all of you to concentrate entirely on this discussion now. Let me start one by one. First item is the broad heading equity and liabilities. Now, there must be a question in your mind, why the word equity? Because when we say NCE, we have proprietorship firm, we have partnership firm, we have HUF. Is there any equity in these NCEs? Answer is no. And that's why my question to the house is, can you tell me any NCE? I repeat and emphasize, can you tell me any NCE in which equity could be there? Can you tell me any NCE in which equity could be there? So equity could be there in case of multi-state cooperative societies. We do have multi-state cooperative societies act, and in case of multi-state cooperative societies, equity is there. So meaning thereby, but we need to understand, if you have any NCE like proprietorship firm or partnership firm or maybe HUF, then you can even change this broad heading suitably. You can simply write capital and liabilities or corpus and liabilities. So you can suitably change this nomenclature from equity to capital or corpus as you deem fit. Now, then is owner's fund. This owner's fund could be transformed to partner's capital also. That is also allowed. Now, just see reserve surplus. Now, generally, what happens in case of proprietorship firm, whatever net profit is there, at the end of the year, journal entry is passed to transfer that profit to proprietor's capital account. Now, if this profit is being transferred, there is no question of surplus. Surplus means P&L account, credit balance. If there is no such kind of a surplus, no problem. And in such a case, it is quite safe. I emphasize, it is quite safe if you delete this row, because this row will be totally irrelevant. It will result in excessive detail. So you can simply give owner's capital account. But now be careful. If you're giving owner's capital account, the guidance note says we need to have a breakup of owner's capital account. This is the breakup. Just see. Just a moment. Just a moment. Just see. This is the breakup. So if you're going to give owner's capital account, the guidance note says you have to give the breakup also. Opening balance, capital reduced, remuneration for the year, interest for the year, minus withdrawals, share of profit or loss, then the closing balance. So this movement needs to be given. So what I'm trying to say, reserve surplus may not be there because they are already transferred to owner's capital account. In such a case, it is quite safe if you delete this row item. But yes, for owner's capital account, whatever movement has taken place, that needs to be given in the notes to accounts. Then is non-current liabilities. In non-current liabilities, what is demanded? They demand that you have to disclose and present long-term borrowings, deferred tax liabilities, other long-term liabilities, long-term provisions. Now, please take a note. This deferred tax liability or deferred tax asset, as the case may be, need not be split into current and non-current category. Deferred tax, be liability, be asset, always is non-current. Please also take a note, which I will be covering after some time. If your client falls into the category of MSME, as per the definition given by ICI, if your client falls into MSME as per the definition given by ICI, then such entity need not compute deferred tax asset or deferred tax liability. That means there is the exemption given to MSME from computation and hence the presentation of DTA or DTL. So we will discuss that thing in detail. There is something in chat box. Let me check. There is a question by Vijayji. Partner's current account, can it be shown in reserve surplus? No. Reserve surplus is not the classification for partners capital account or current account, because these are not reserves primarily. Reserves generally are created from profits. And for that very reason, what you will do, you will give a bifurcation of owners funds into partners capital account and current account, as the case may be. Now, when we move forward, we have current liabilities, short-term borrowings, trade payables. Now, trade payable is having two breakup: total outstanding dues of micro, small, and medium enterprises, and total outstanding dues of creditors other than micro, small, and medium enterprises. Then other current liabilities, then short-term provisions. Now, be careful. You may recall that Form 3CD was amended very recently. In March 2025, a notification was given, and by virtue of that notification, this Form 3CD was amended. And by virtue of the amendment, some more details are required by Form 3CD regarding dues towards MSME. And for that very purpose, be careful that the information warranted by Form 3CD should map with this disclosure. That is total outstanding dues of micro, small, and medium enterprises and total outstanding dues other than micro, small, and medium enterprises. Now be careful when you refer Schedule 3. In Schedule 3, the wordings are total outstanding dues of micro and small enterprises, and then total outstanding dues of creditors other than micro and small enterprises. But when it comes to guidance note, the guidance note uses the words micro, small, and medium enterprises. Whereas in Schedule 3, the words medium enterprises are not used. So be very careful. Do not copy paste from Schedule 3. Are you getting my point? So this is something about the reporting and the disclosure practices of guidance note format, micro, small, and medium enterprises, and you need to map this information sufficiently in detail so that it could be mapped with Form 3CD also. There's a question by Anuragji, how to write equity and liabilities in case of trust. So in case of trust, Anuragji, it will be corpus and liabilities. So the word equity will be given a new name, corpus, or some people can even give the name as funds. And then funds can be bifurcated into restricted funds and unrestricted funds, as the case may be. Am I clear, Anuragji? Okay. So the way we have seen non-current liabilities, we have seen current liabilities as well. Now be careful. In current liabilities, we have trade payables. If you see very minutely, in current liabilities, we have trade payables, but do not have trade payables in non-current liabilities. So if there are any non-current trade payables, they will be shown below the heading other long-term liabilities. So this needs to be taken care of. Next. The discussion which I'm going to make for long-term borrowings shall also be applicable to short-term borrowings. So please understand the discussion of long-term borrowings so that we can save time for short-term borrowings. Now, Institute says when you disclose long-term borrowings in balance sheet, just see here, we have long-term borrowings. So they say when you disclose long-term borrowings over here, and the same way when you show short-term borrowings over here in current liabilities, the breakup should be given in the notes to account. And this is the breakup. Long-term borrowings may be classified as term loans from banks, from other parties, deferred payment liabilities, loans and advances from RPs, long-term maturities of finance lease obligations. So if you have taken some assets on lease, and it is a say 15 years of lease, so what you have to tell, out of total lease payments, what are those payments which are due after 12 months from the balance sheet date? So whatever amounts are due after 31st March 2026, they needs to be disclosed over here. Then other loans and advances. Then this is something important. Borrowings may further be. See, the word is may. Here the word is may. Please focus over here. The word is may, and then again the word is may. So the word may is used. That means it is not a mandatory requirement. You may avoid it. But my suggestion will be to give. But still, if you want to avoid, you may avoid. So this disclosure primarily is not mandatory because may word has given you enough flexibility. And what they say here, borrowings may further be subclassified as secured or unsecured, and nature of security shall be specified separately in each case. Now see, here it is may, then it is shall. That means if you have decided to disclose borrowings into secured and unsecured portion, then you have to, then it is no option. Then you have to give the nature of security specified separately for each case. Similarly, where loans have been guaranteed by partners, proprietors, etc., the aggregate amount of such loans under each head shall be disclosed. Terms of repayment of term loans and other loans may be stated. The word is again may. So you took the loan and security of stock. And what they say that you have to repay the loans, let us say in next 12 months or 20 months or 25 months. So that terms of repayment needs to be disclosed as well. And but it is for not only term loan but other loans also. So short-term loans are also covered. Let me give you a question over here. Just see this question. RSN company, a partnership firm, has borrowed rupees 1,000 towards the term loan from various banks. The details are as follows. Rupees 200 from Punjab National Bank, secured by the building owned by the firm. The market value of the building is 500. Rupees 300 from HDFC, secured by the building owned by the firm. The market value of this building is 500. Rupees 400 from NBFC, secured by property, plant and equipment of this firm. Market value of this property, plant and equipment is 500. Rupees 100 from another NBFC, guaranteed by the partners jointly in their profit sharing ratio. So my question to the house is, you have the breakup of rupees 1,000 being given. So I have two questions. First question is, please tell me what is the total amount of secured loan and total amount of unsecured loan. This is my first question. And second question is, can we disclose the loan in this way, term loan 900 secured against property of the entity? So let me come to the first question initially. What is the total amount of secured loan and total amount of unsecured loan in this question? There is a question by BJG in the chat box. Can we add other income or expense in capital account? Answer is yes. That flexibility is given by the guidance note. Shankarji says fully secured. Okay. Hariji says 900 secured. So answer given by Hariji is correct. Answer given by Arunji is also correct. Please understand, when we say secured loan means against the property or assets of the entity. So this rupees 100 is not secured. It is rather guaranteed. Secured means secured against the assets of the entity. And that's why this 200 plus 300 plus 400, 900 will be secured loan. And when this is secured, please do not write like this. Do not write like this, secured against the property, because you have to give the security nature for each category. So this is the way of writing security nature for each category. And what about this rupees 100? This rupees 100 is not secured loan. It is unsecured loan. And what you will do, when you will write rupees 100 in unsecured loan, you will also write that this rupees 100 is guaranteed by the partner or proprietor, as the case may be. I believe this point is clear to each one of you, because whatever discussion I made over here, the same discussion also applies to short-term borrowings in mutatis manner. Shall I proceed further? Is it clear? Any question you can write in the chat box. And please be careful, the words are may, so it is your choice and your wisdom, what you want to give, what you want to avoid. Okay. Now just see, long-term provisions. So long-term provisions may be classified. Again, the word is may be classified as provision for employee benefits, others. So whatever salary payable is there, whatever wages payable are there, that you may take into long-term provisions or short-term provisions, as the case may be, depending upon 12 months involved. So if some amount is payable after 12 months, it will go into long-term provisions. If it is less than 12 months, it will come into short-term provisions. So whatever I discuss for long-term provisions is mutatis mutandis applicable to short-term provisions also. Let me show you the format once again. This is format. In non-current liabilities, we have long-term provisions, and similarly, in current liabilities, we have short-term provisions. So depending upon the periodicity involved, frequency involved, you will classify the same. Short-term borrowings I'm skipping because I have already covered this with the help of long-term borrowings discussion. Short-term provisions I'm also skipping because I have already covered with the help of long-term provision. Now come to the asset sides. In asset side, we have non-current assets and current assets. If you see non-current assets, the first caption is property, plant and equipment, and intangible assets, then we have to give the breakup, like property, plant and equipment, intangible assets, capital work in progress. Let me stop over here. Normally, the practice has been that non-corporate entities are disclosing capital work in progress along with property, plant, and equipment block. Now, this is not allowed. Once you follow this guidance note, you have to segregate property, plant, and equipment from capital work in progress, because capital work in progress is a separate line item. Then is intangible assets under development, then non-current investments, then deferred tax assets. As I told you, DTA need not be classified into current and non-current portion. It will always be considered as non-current. But yes, if your non-corporate entity falls into MSME category, then total exemption is there from accounting of deferred tax. Then is long-term loans and advances, then other non-current assets. Similarly, for current assets, we have current investments, inventories, trade receivables, cash and bank balances, short-term loans and advances, and other current assets. Like we have trade receivables here in current assets, there is no trade receivable in non-current assets. So if there are certain trade receivables which are non-current nature, what you will do, you will show them below the heading other non-current assets. Let us discuss some of the items in detail. Property, plant, and equipment. Of late, this is a practice of the non-corporate entities that in the block of assets, they show land and buildings together. But no, it is not allowed. As per accounting standard 10, land is a separate component, building is a separate component. So it is wrong to say land and buildings, because in that very sense, what happens, land cost is also depreciated. So land needs to be segregated from buildings. How to segregate, that will be a kind of cumbersome exercise. But yes, these accounting standard 10 requires segregation. And how to do the classification in the block of assets, land, buildings, plant and equipment, furniture, fixtures, vehicles, office equipment, others. If you have some assets under lease, they will be separately disclosed. And number third, a reconciliation of gross block and net block needs to be given, along with the additions, deletions, depreciation, etc. And if revaluation is being made and the revaluation change is more than or equal to 10%, then that revaluation needs to be disclosed separately. Now, here is a challenge. The challenge is in the form of a question. Let me show you a question first of all. I will come to these clips in a while. Let me show you a question first of all. The clips I'm skipping, I will come to them in a while. Just see this question. ABC and Company is a partnership firm. The depreciation was provided in the books of accounts in accordance with the rates prescribed under the Income Tax Act. What audit consideration should be observed by the auditors in this regard? So be very careful for this question, because I believe this question is quite relevant for all of listeners. It had been a long practice and it is still prevalent that in the books of accounts of NCEs, the depreciation is provided as per section 32 of the Income Tax Act. But it is wrong. Why it is wrong? Because accounting standard 10 says depreciation has to be provided on the basis of estimated useful lives. So what to do in such a case? So please understand, people, it's a contravention of accounting standard 10. And because it's a contravention of accounting standard 10, we have to qualify. There is no other option, we have to qualify. Now, there can be two scenarios. Scenario number one, because of this contravention, you're able to identify the financial impact. And second could be the financial impact is not determinable because data was not there. So I'm showing you something. You may use this paragraph in your own audit report as per suitable modifications. We do have auditing standard number 705, SA 705, and SA 705 that you have to qualify. And when you qualify, you have to give the financial impact of qualification to the extent practicable, to the extent determinable. Let me show you two alternatives. Alternative number one, how to qualify where financial impact is determinable. Just see the paragraph. The firm has provided depreciation on property, plant, and equipment at the rates prescribed under the Income Tax Act instead of depreciating the assets over their estimated useful lives as required by AS10 property, plant, and equipment issued by Institute of Chartered Accountants of India. As a result of this departure, the depreciation expense for the year is lower or higher as the case may be by rupees so and so, and the carrying amount of PPE as at the balance sheet date is higher or lower as the case may be by rupees so and so, with a corresponding impact on net profit. This is the paragraph which you may use when the financial impact is determinable. Now, what is the meaning of financial impact? Depreciation as per AS10 versus depreciation as per section 32. So whatever impact comes up, that is determinable. You can qualify like this. But I believe from my little experience that in most of the cases, this financial impact may not be determinable. Then what to do? If this financial impact is not determinable, then you can qualify in this manner. The firm has provided depreciation on property, plant, and equipment at the rates prescribed under the Income Tax Act, rather than on the basis of their estimated useful lives as required by AS10, Property, Plant and Equipment, issued by Institute of Chartered Accountants of India. The firm has not maintained records of estimated useful lives of individual PPE. Further, no technical assessment or management estimate of useful lives has been made available to us. In the absence of necessary records and estimates relating to useful lives of property, plant, and equipment, it is impracticable to reliably quantify the impact on the depreciation expense, carrying amount of PPE, and the net profit. Please be careful in this entire paragraph. Nowhere we are writing that books of accounts were not properly maintained. Nowhere we are claiming, nowhere we are commenting that invoices for purchase of plant and machinery were not there. We are simply saying that no records are there for technical assessment of useful lives. And in this very way, the qualification will survive and there will be no professional misconduct per se. Are you getting my point? Am I clear? So if the crux needs to be given, the crux could be like this: whatever block of assets your client was giving earlier as per section number 32 of the Income Tax Act, you can still move ahead with the same concept, with the same customary practice, but because ideally it is a contravention, it will be a safeguard for the auditors or the attestators to give this qualification. Am I clear? Avinash, am I clear? Vijay, am I clear?
Yes.
Okay. So these are the two qualification paragraphs. Once you will get the PPT, you will find these paragraphs in that sense also. Now let me go back.
There is one common query on this. That now, as we all know, that we have been following, most of the people have been following depreciation under section 32 of the Income Tax Act.
Yes,
and
sir.
we have a closing WDV which is based on that.
Yes.
So supposing we have to rewrite the books, how do we go about the opening WDV and conforming to the gross block concept?
So Vijay, that will require a lot of effort because you have to go retrospective. You have to search a lot of data and information. So if it is available with you, then it will require effort. And if it is commensurate with the remuneration you're getting, one must do. But if it is not possible to be done, or if it is not feasible to be done, I would suggest move with the same practice, but qualify. Because what I must say, Vijay, the qualification which I have shown you, this qualification will not have any kind of a damage to the client. Because primarily assessing officer has no business to do with the accounting standard 10.
Yeah, agreed. But this is a common query you must have also faced, and there are lot many queries similar on the YouTube.
Yeah,
also.
even in my own case, this is happening with some of the clients. So what I did, I simply decided to give this qualification so that I am also safe, the client is also safe, and the other records are also safe.
Okay, thank you.
Now, the way we have discussed property, plant, and equipment, the same way, mutatis mutandis, the same concept is applicable to intangible assets also. So, in the interest of time, I'm not reading intangible assets because the theoretical part we have already covered for property, plant, and equipment. Then is non-current investments. Now, whatever discussion I will make for non-current investments is mutatis mutandis applicable to current investments also. Now, non-current investments, guidance note says that non-current investments, which you will reflect in the face of balance sheet, shall be given the breakup in the notes to accounts. And what they want, non-current investments shall be classified as trade investments and other investments as follows: investment in property, investment in equity instruments, investment in preference shares, investments in government or trust securities, investment in debentures, mutual funds, partnership firm, other non-current investment. For example, if you are a proprietorship firm and you are also a partner in LLP, then this LLP will come over here. So depending upon the nature of investments, you will provide the breakup of the same. And further, they want under each classification, details may be given. Just see the word may be. So please remember, this major classification is mandatory. Non-current investment shall be. So you cannot avoid this breakup. But yes, here for each such classification, other things are optional. Under each classification, details may be given of the names, disclosing separately of JVs, special purpose entities, etc., etc. So this is mandatory from A to H, whatever is applicable to you, but this is not mandatory. Similarly, the guidance note further says investments carried at other than cost should be separately stated. For example, market value of investments, mutual funds are there, they are at NAV, so that shall be separately disclosed. The following shall also be disclosed, the word is shall: aggregate amount of quoted investments with market value. So if you have made some investments, let us say in the securities of Reliance Industries Limited, so you will tell that this much of the amount is in quoted investments and the market value as on 31st March is this much. Aggregate amount of unquoted investments, and then aggregate provision for diminution in the value of investment. So if there is some impairment in the value of investment, that impairment needs to be given separate. That is what the requirement of non-current investment is. And in the same way, we have the same requirements, mutatis mutandis, even for nothing but short-term investments. Now, what about long-term loans and advances? See the word may. So you are a NCE and you have given some loans and advances. Then the institute says long-term loans and advances may be classified. So in the balance sheet, the main item is long-term loans and advances. Whatever I am discussing here is mutatis mutandis applicable to short-term also. So balance sheet will show long-term loans and advances. In the breakup in notes to accounts, you may classify such long-term loans and advances into capital advances, advances to parties related, and other loans and advances. And then once you give this disclosure, if you decided, then you have for one more option to go ahead with. This loan and advance may further be subclassified as secured, unsecured, doubtful. And if there are some allowances or bad and doubtful loans, that shall be disclosed separate. Let me see in the chat box. There is a question by Arvind ji. In case client maintains personal balance sheet and firm balance sheet combined, is it necessary to segregate? Arvind ji, if there are two sets of balance sheet, one is called as statement of personal affairs and second is a business balance sheet. This guidance note is applicable only to business balance sheet. So to combine or not to combine is your choice. But yes, if you're combining, to the extent you're combining, this guidance note is not applicable. There is a question by Vijay ji. In this format, we will not be able to show all the assets individually. For example, if assessee has two machinery, then is required to be shown in the block rather than. So what will happen now, if there are two machineries, they will be aggregated below the heading property, plant and equipment. Like we do for companies, the same thing will happen here also. Can we change the format given by guidance note? So Tanu Khatriji, the guidance note format cannot be changed, but it could be adapted to suit the circumstances like corpus and liabilities. So this could be done, but you cannot change the format. Otherwise, the whole sanctity of guidance note will be lost. Then is other non-current assets. So other non-current assets will be security deposits, bank deposit, like you have FD of more than 12 months, that will come over here, others. So depending upon, like you have taken electricity connection, and for electricity connection, you have given some security deposit, it will come over here. If you have taken some property on rent and some security deposit is given, which is for more than 12 months, that will come over here. So whatever I discuss for non-current investments is mutatis mutandis applicable to current investments. So I am skipping this one. Then is inventories. Inventory shall be classified into raw materials, WIP, that is work in progress, finished goods, stock in trade. This stock in trade will come only when you are a trading enterprise. Then stores and spares, loose tools, others, if any, will be specified over here. If goods in transit are there, then they will be disclosed separately. So for example, if there are certain finished goods and they're in transit, so below the finished goods, you will also reflect goods in transit quantum. Then mode of valuation. Now what is mode of valuation? Cost or NRV, whichever is lower. So that needs to be disclosed. There's a question by Vijayji, what will be the reporting when client is not providing depreciation on office or building since marriage? So Vijayji, as I discussed the qualification paragraph, the same qualification paragraph can be mutatis mutandis revised or adapted in this case also. You can simply say depreciation was not provided on the building. So that qualification will be sufficient. There is a question by Vishal Bhojwani ji, sir, can we change the format of depreciation of gross block as fair presentation will not be there? That's the Vishal ji I told you. If you change the format of depreciation as per the guidance, not fair enough. But if it is not possible or is not feasible to be changed, you can continue with the old format. But in that very case, you have to qualify. How to qualify? I already shown you the paragraph. So Vijay ji and Vishal ji, am I clear? Okay, let me proceed now. Then is trade receivables. So someone asked me the question on trade receivables in the beginning. Let us resolve that question now. So what this guidance note says, aggregate amount of trade receivables outstanding for a period exceeding 6 months from the date they are due for receipt may, you see the word may, be stated separately. So debtors exceeding 6 months and debtors less than or up to 6 months, they need to be bifurcated, but that is totally your choice because the word is maybe. Then is trade receivables may further be subclassified into secured, unsecured, and doubtful, and allowance for bad and doubtful debts, if any, shall be disclosed separately. So I believe the person who asked me this question about 6 months criteria must have understood that this is optional. And please be careful. These 6 months shall be counted from the due date and not from the invoice date. Be very careful. These 6 months are counted from the date they're due. So invoice date is not relevant, rather due date is relevant. So depending upon that due date, if you wish to disclose this bifurcation of 6 months and less than up to 6 months, you may go ahead, but count the 6 months period from the due date of invoice, not from the invoice date or the balance sheet date itself. Let me take up some questions in the chat box. There's a question by Hariji. What about retention money, trade receivable, which is due after 12-24 months? They will due only after that milestone. So Hariji, first of all, retention money is not trade receivable. So it will be a separate classification of retention money, as you may say, as other receivables, and depending upon that criteria, trade receivables classification of 6 months will not be applicable. Am I clear, Hariji? So it will be not apt to say that retention money is trade receivable. Retention money is not classifiable as trade receivable. It will be other current assets or maybe other non-current assets depending upon the contract you have.
Normally, it is deducted from the bill. So, I mean, sale invoice.
Yes,
So,
that's why I'm saying that this 6 months criteria, or rather not 6 months, this trade receivable caption itself is not applicable to retention money. So retention money is not trade receivable. So what will happen? Trade receivable, then other current assets or other non-current assets. Below other current assets or other non-current assets, this will come up as retention money. There's a question by Vishal Bhojwani ji. Can we present financial statements in actual value rather than amounts in hundreds? Answer is yes, Vishal ji. As I told in the beginning also, rounding off is optional because the word may is used. So it is totally your choice. You may give actuals also, or if you wish, you may round them off also. There is a question by Sunil ji. EMD paid to contractee will be non-current. So Sunil ji, it will be dependent when this EMD is going to be crystallized. If it is going to be crystallized in immediate next 12 months from the reporting date, that is 31st March 2025, it will be current, else it will be non-current. There is a question by Bhupender Maheshwari ji. If client is a service provider, inventories is not applicable, then how to report? Simply delete the line. If you are a service provider, then this inventory wala clause itself is not applicable. And that's why these guidance note instructions themselves says excessive details are not required. Am I clear, Bhupender ji? So if you are a service provider, inventory reporting clause will not be applicable. So you can simply delete this whole entire agenda. I believe, Bhupender ji, I am clear. Now then is cash and bank balances. So similar to what we are doing in Schedule 3, the same analogy can be drawn upon here. Cash and cash equivalent shall be classified as balances with banks, checks, drafts on hand, cash on hand, others. Then other bank balances will comprise of bank deposits, earmarked balances with banks, margin money. So generally it happens that you are taking overdraft against FD. So that FD will come over here. Then bank deposits with original maturity of more than 3 months, but less than 12 months. So if there is a short-term FD, that will come over here, then others. So this is the same scenario which we are doing in Schedule 3. So I will not invest much of the time over here because it is quite understandable by each one of us. We are quite customary into it. Then short-term loans and advances. This I already covered with long-term loans and advances. So in the interest of time, I may skip this one. Then other current assets. So other current assets is the kind of residuary heading. So this is an all-inclusive heading which incorporates the current category which are not covered over here, like prepaid expenses. So if you have some prepaid expenses, these prepaid expenses will come in the heading of other current assets. So I believe up till now you must be able to understand the gravity of balance sheet items. There is a question by Vijay RMGST on YouTube. What if audit is first time and no opening balance is available? So if audit is first time and no opening balance is available, no need to give comparatives. Then there is a question from a YouTube participant. No head for saving account in current assets under bank account. So see, saving account will be there only when it's a personal kind of a scenario. So it's a personal affair. The guidance note is applicable only when you are running a business. So in that very case, if savings accounts are there, that will be outside the scope of guidance note. So either you have to decide to combine the balance sheet or to prepare a separate balance sheet. So even if you will combine, the extent of guidance note will not be applicable. Then there's a question by Hariji, any disputed tax pre-deposit before appeal. Again, Hariji, it will come into other current assets. So depending upon, again, I would say depending upon the probability, how this appeal will be tackled, maybe next 12 months or more than 12 months, then you may bifurcate. But generally what happens in this kind of a pre-deposit, people do classify it into other current asset. Let me see some more questions in the chat box. Negative balance of income and expenditure in case of trust to be shown under reserves and surplus. So whatever negative balance of income and expenditure is there, it will be a kind of P&L debit balance. It will travel into reserve surplus, and then it will be knocked off with the total corpus. Just like we do in Schedule 3, the same thing will apply over here. Am I clear, Anuragji? Then contingent liability. So at the footnote of balance sheet, you have to disclose contingent liabilities not provided for, like claims against non-corporate entities not acknowledged as debt, guarantees, and other money for which non-corporate entities contingently liable. So I'd always do believe sometimes copy-paste results in suffering. In my little experience, what I found in past few months, what people are doing, people are simply copying and pasting the format of Schedule 3, and then they're changing the nomenclature of Schedule 3 format. Please understand, there are certain items in Schedule 3, and these items are not in the guidance note. For example, in this guidance note, there is no disclosure for commitments. So the format for financial statements of non-corporate entities, on one hand, require disclosures for contingent liabilities, but there is no disclosure requirements for commitments. So this commitment, which is there in Schedule 3, need not be given in guidance note. So this is about balance sheet. Let me come to statement of P&L. Very simple scenario again. This is the format of P&L, like level of rounding of name of the entity, period involved, current year figures, past year figures, and so on. So let me discuss items one by one. There is a question by Nehaji. If combined financials are prepared for business and personal, what would be applicability of guidance note? So Nehaji, in that very case, guidance note will be applicable only to the business perspective, not to the personal perspective. So it will be a tough call. I would suggest to prepare two sets of balance sheet, one for business and one for personal, so that the things could be in order rather than becoming chaotic. Otherwise, what will happen? You will somehow, by virtue of overlooking, extend the applicability of guidance note even to the personal account. So that will not be a proper idea. Am I clear, Nehaji? So the best approach is to segregate. But even if you wish to combine, then make sure that you are applying this guidance note only to the extent of the business affairs. Now, what does the format of P&L requires you? Very simple format, very crisp format. So the guidance note says, in P&L, you have to reflect this information: revenue from operations, other income, then expenses will be having a breakup of cost of goods sold, employee benefit expense, depreciation and amortization expense. You may see this red ribbon is there. The red ribbon is for one purpose. This depreciation, if it is not as per AS 10, then you have to qualify. This depreciation, I repeat, if it's not as per AS 10, then you have to qualify. How to qualify? I already covered. Then is finance cost, other expenses. Please take a note. If your non-corporate client has pays interest under Section 234A, B, and C of Income Tax Act, I repeat, if your non-corporate entity client has paid interest under Section 234A, B, or C of the Income Tax Act, then that interest will be reflected below finance cost. It is not other expense. So you have to be careful for that. Then the format further says, disclosure about exceptional extraordinary item, profit before extraordinary item, before after extraordinary item, then tax expense. In tax expense, we have to disclose current tax and deferred tax. This red ribbon is there. The motive of red ribbon is this deferred tax computation need not be done if your NCE, non-corporate entity, is MSME. How this MSME is becoming, we will see in a while. Then this breakup is being given. Just see the first paragraph, which I already covered. The provisions of this part may be applied even to income and expenditure account in the like manner as they apply to statement of P&L. So if you are a NGO or NPO, then you may prepare income and expenditure account in mutatis manner. Revenue operations can be disclosed like this: sale of products, sale of services, grants or donations. So if you received some subsidy, that will be coming over here. Other operating expenses, then excise duty. So if you are running a petrol pump, then on this petrol, GST is not applicable, so excise duty is there, so that you will be reflecting like this. And if you're running a finance non-corporate entity, just see, in respect of finance NC, for example, you may have a thrift and credit society. So if you have a thrift and credit society, it is NC, but it is in the nature of finance business. So for that very entity, the revenue will be from interest and other financial service. So this breakup is required. It is on the same lines as we have seen several times in several years in Schedule 3 also. Then is Cost of goods sold, the breakup thereon, materials consumed, purchases, changes in inventories, work in progress. Finance cost, as I already covered, it will be having a bifurcation of interest expense, other borrowing cost applicable, forex currency loss or gain, as the case may be. I must reiterate, in this interest expense, the interest paid under Section 234A, B, and C of Income Tax Act will also be reflected. Then other income will comprise of interest income, dividend income, gain or loss on sale of investments, and other non-operating income. And this non-operating income can be shown after netting off the directly attributable expenses. Then there are some more instructions. Out of these more instructions, the guidance note says disclose separately employee benefit expense into salaries, wages, contribution to PF, staff welfare expense, etc. Then materiality threshold, guidance note says if any item of income and expenditure is exceeding 1% of total revenue or rupees 1 lakh, whichever is higher, that shall be separately disclosed. Meaning thereby you have an item, other expenses. In other expenses, simply do not write rupees 1 lakh. You have to check whether this rupees 1 lakh exceeds this threshold. If yes, then you will not classify it as other expense, rather you will name it. So whatever name will be like repair expense or maintenance expense, that will be coming separately. Then adjustments to carrying amount of investments shall be separately disclosed. Foreign currency loss shall be separately disclosed in finance cost, etc. Details of exceptional items, separate disclosure. Prior period items, separate disclosure. Expenditure under following heads, separate disclosure like consumption of stores and spares, power and fuel, rent, repairs to building, repairs to machinery. Just be very careful. It is repairs to building, not repairs and maintenance. So maintenance word is not there. Similarly, repairs to machinery, repairs and maintenance is not there. So if you are reflecting an amount, repairs and maintenance, please be doubly sure that the maintenance expense is not material. If it is material, then you have to follow this clause number B. That is disclosed separately. Then rates and taxes, insurance, miscellaneous expenses. That is what P&L statement requires you to do. This case study I already covered, so I will skip this one. Now, it is the right time to understand whatever we discussed, it's okay. Now, what is not there in the format of guidance note? So there are certain items which are in Schedule 3, but are not in the guidance note format. These are the items. So guidance note says many things, but is silent on these things. So A, B, C, D, E, F, T till I. This information is not required, like aging analysis not required, ratio analysis not required, additional regulatory information like crypto assets not required, CWIP aging schedule not required, repatriation restrictions not required, loans due by owners not required, and just see auditor remuneration. I have a red ribbon over here. So in P&L, you have to give auditor remuneration, but the breakup of audit remuneration, like for tax audit, for other attestation, not required. But I would suggest still give this breakup. Why? The guidance note is silent, but the format in Excel worksheet available on ICA website, that format in Excel shape, which is available on ICA website, that format has given the breakup of auditor's remuneration. So keeping that format also a sanctity format, I would suggest in notes to accounts, you must give the breakup of auditor's remuneration. So if you are the tax auditor of a non-corporate entity, then whatever fees you're getting, that breakup should be given as tax audit fees, certification fees, etc. Now, here comes the other thing, announcement regarding revised criteria for classification of NCE. Now, on 8th November 2024, the criteria for applicability of AS has undergone a change. And this criteria is applicable for the first time from 2425. You have to decide whether your non-corporate entity is MSME or not. Just see. So, who is large entity? Large entity means other than MSME. Please be careful, this definition of MSME has nothing to do with MSME Act. I repeat, this definition of MSME has nothing to do with the MSME Act. It is a definition of ICI only for the purpose of accounting standards applicability. Now, what does ICI says? And this, I must again emphasize, this is applicable for 24-25 onwards. Now, micro, small, and medium size entity at the end of relevant accounting period. So, as on 31st March 2025, as on 31st March 2025, if all these conditions are fulfilled, then it will be MSME. Now, what are these conditions? Let us see one by one. Equity or debt securities are not listed or are not in the process of listing. Now, you may wonder how it is possible that non-corporate entity can get itself listed. So now we have a concept of social listing. So if you have a trust and this trust is NCE, by virtue of SEBI ICDR regulations, this NCE trust can get itself listed. So the very moment it will get listed, it will be listed on social stock exchange. So that's the reason this provision is there. It's not a bank, financial institution, or insurance company. For example, we have credit societies, thrift societies. They will fall into this category. In this number 3 and number 4 point, most of our client will fall upon. Turnover excluding other income is up to rupees 250 crores in the preceding accounting year. So if this condition is fulfilled, you are MSME. Borrowings up to rupees 50 crores at all times during the immediately preceding accounting year. So if this condition is fulfilled, again you are MSME. And then lastly, you are not a holding or subsidiary of any of the large entity. So if all these conditions are fulfilled, then you will be called as MSME. And then several exemptions are there from applicability of accounting standard. Be very careful. We will check all these conditions on 31st March 2025. But this turnover and borrowing condition is taken from preceding year. So we have to check as on 31st March 2025, we have to check this turnover or borrowings of 31st March 2024. Just see this question and tell me whether it is MSME or not. Entities XYZ, you have to tell me whether it is MSME or not. The nature is NCE, it is not listed. Turnover for 2324 is 250 crores, including FD interest, and then borrowings 2324 35 crores. Not a financial institution or insurer, and it's not a holding or subsidiary of any large entity. So please tell me whether it is MSME entity or a large entity. It is MSME. Why? Because turnover is less than 250 crores and borrowings are also less than 35 crores. But for which year? Last year. We have to check the last year. Now see this question. Question number 2. In this question, what is your answer? MSME or large? It is again MSME. Just see, it is MSME because last year turnover is less than 250 crores and last year borrowings is exactly 50 crores. And what the symbol was? Just see the symbol, less than equal to. And that's why it is again MSME. Here is question. What will be the answer? Whether Samriddhi Education Trust in this question is MSME or large entity. It is large entity or not MSME. Why? Because it is in the process of listing on social stock exchange. Now, compliance with accounting standards. So once you become MSME, then these exemptions are available. I will touch upon some of the important exemptions. Rest you can read on your own once you get the PPT. So I will read the red highlighted one. AS22. If you are MSME, then no need to compute deferred tax. What is required only is compute current tax. Now there could be a scenario that deferred tax is there for the year ending on 31st March 2024. Now institute says if you have some deferred tax as opening balance, it could be liability or it could be asset. Then what you will do? You will adjust it against the opening revenue reserves or capital account. Meaning thereby, if on 31st March 2024 you have deferred tax liability, on 1st April 2024, what you can do? You can pass a journal entry as deferred tax liability account debit to capital account. Or if you have deferred tax asset, you can pass the entry as capital account debit to deferred tax asset account. This is what the liberty is being given to MSMEs. Similarly, if you are MSME and you fulfill 2 more conditions. So first you are MSME, then you fulfill 2 more conditions. What are the conditions? In the preceding year, your turnover was up to rupees 50 crores and your borrowing, just see, the word is and your borrowing is up to rupees 10 crores. If these 2 additional conditions are also fulfilled, then no need to give any disclosure for RPT. So RPT means related party transactions. So that disclosure is not required because AS18 is not applicable in entirety. Similarly, if you are MSME, no need to go for actuarial valuation. Just see. So if you are MSME, on your entity, payment of gratuity may be applicable. But in that very case, because you're MSME, no need to go for actuarial valuation. That is what exemption is being given. So once you will get this clip, you may be having the fair idea what to do and what can be exempted. And if you're a large entity, no other option but to comply with all the accounting standards. That is what the liberty is being given to non-corporate entities. Let me see some questions in the chat box. There's a question by Bhupendra Maheshwari ji, whether turnover and borrowings both have to be taken into account together. Answer is yes. There is a question on YouTube. P&L appropriation in case of partnership. As far as guidance note is concerned, guidance note has not given any concept of P&L appropriation account. So to my understanding, if you want to add P&L appropriation account, you can add up. because I believe it will not be a contravention of guidance note. Then again, there is a question from some participant on YouTube. May I know how to show direct expenses, how to show gross profit in the format? So as far as direct expenses are concerned, you have these separate headings: cost of goods sold, cost of inventory consumed, and so on. So these are the direct expenses, and then you can get the breakup in the notes. And as far as GP is concerned, there is no separate row item for showing GP or NP separately. So that is the, you can say, demerit or the disadvantage of this guidance note, that GP and P is not given separately as far as the new formats are concerned. There is a question from Bhupinder ji. If borrowing is 75 crores and turnover is 180 crore, whether it would be large? Answer is yes. Because the borrowings are exceeding 50 crores, it will be a large entity. So borrowing condition and turnover condition both needs to be fulfilled. In your case, Bhupinder ji, borrowing condition is not getting fulfilled, so it will become large entity. Now let me move forward. These are the additional requirements. What the guidance, what the new criteria says. This is something important because this will be first year of applicability. The announcement dated 8th November 2024 says MSMEs availing exemptions must disclose the exemptions availed by them and their status as to whether they're MSMEs or not. If an entity ceases to qualify as MSME, full AS compliance applies from the current period with disclosures of the past MSME status and unchanged previous period figures. What is the meaning of this sentence? So you were MSME in the preceding year, but now in this year you became large. So all the AS will become applicable and there is no need to change the previous year figure. So comparatives need not be adjusted. But however, an entity must remain MSME for 2 consecutive years before availing AS exemptions or relaxations for MSMEs. So if you were large entity in the previous year, but you become MSME in the current year, so you have to wait for 1 more year. That is next year. If you remain MSME in the next year also, then only you will get the exemptions. So 2 years cutoff period is there. Now, liberty is given. MSMEs partially availing exemptions from any AS must disclose the specific standards. MSMEs choosing not to avail exemptions must fully comply, and MSMEs may avail partial AS exemptions within it, but that must not mislead financial statement. What is the meaning of these 3 bullet points? Several exemptions are there. It is totally your choice. It is totally your choice how much exemptions you want to avail. You may avail partial exemptions, you may avail full exemptions, but whatever exemptions you are availing and whatever exemptions you are not availing, you have to disclose the effect. So you have to disclose the quantum of exemptions availed and quantum of exemptions not availed. Let me discuss few case studies about this whole scenario of 2 years for relaxation and cooling off period. Question number 1. So let us assume this data pertains to a proprietorship firm. So this table is there. Keep other things as constant. Basis this. Now please tell me, basis this data, can this proprietorship firm claim AS relaxations in the financial year 24-25? Answer is no. I got one answer from Preeti ma'am. Answer is no. Why? In 24-25, it is MSME, no doubt. But if you see the last 2 years, it was large. Meaning thereby, had it been MSME for 2 consecutive years, only then exemptions could have been availed. And this is not so in this case. And that's why in 24-25, the exemptions are not available. So for this year, when you discharge your services to your client, please do check whether the client is becoming MSME or not. One more case study. Just see this case study and tell me whether exemptions will be available in 24-25. Answer is yes, because for 2 consecutive years, you are MSME. So exemptions will be available. Check this question, whether exemptions will be available. Answer again is yes, because for 2 consecutive years, you are MSME. So exemptions are available. Now, what is the, if I say kind of a layman answer, simply check whether you are MSME in 24-25 and whether you are MSME in 23-24. If the MSME status is there in both these years, what will happen? You will be able to avail the exemptions for this year. Now be very careful for this question. Can you claim AS relaxations in 25-26? Because if you see in 25-26, the current year turnover is less than 250 crores and borrowings are less than 50 crores. But this is irrelevant in 25-26 because in 25-26, whether you will be MSME or not will be dependent upon previous year. In previous year, it was 260 crores of turnover and because it is more than 250 crores, it will lose the status of being MSME. So now, because in 25-26 it is no longer MSME, exemptions stand withdrawn and exemptions will not be available to this proprietorship firm. I believe this point is clear to each one of you. Now, a very big question, the last discussion of this topic which is given to me, what if NCE does not comply with the guidance note? I personally believe that my fellow professionals may face a kind of challenge that the non-corporate entity may not be cooperating and complying with this guidance note. And if they don't comply with this guidance note, there is no other option but to qualify. And how to qualify? So I'm giving some sample qualification which you may use as you want. So if the non-corporate entity is not complying with the guidance note, and let me assume tax audit is applicable upon such entity, then in para number 3 or 5, as the case may be upon 3CB, this kind of qualification can be given. The series table, this will be helpful. First, you will write basis for qualified opinion. Like it's a sample paragraph. You may adapt it as per your requirements. The financial statements of XYZ, whatever entity name is, have not been prepared in accordance with the formats for financial statements prescribed in the guidance note on financial statements of non-corporate entities issued by the Institute of Chartered Accountants of India. In our opinion, while this represents a departure from the prescribed presentation framework, it does not materially affect the information presented regarding the entity's financial position, financial performance, or owner's equity for the year ended on such and such date. Please understand the crux. If the format is not followed, but accounting standards are followed, that does mean there is no impact on income, asset, liability, etc. And that's why we are simply saying that format is not being followed. And then what we'll write in qualified opinion, in our opinion, and to the best of our information and according to the explanations given to us, except for the matter described in the basis of a qualified opinion paragraph, that is this paragraph, the financial statements present fairly in all material respects the financial position of the entity as at 31st March 2025 and its financial performance for the year then ended in accordance with applicable financial reporting framework. Applicable financial reporting framework means accounting standards issued by Institute of Chartered Accountants of India. So if guidance note is not complied by the client, then I would suggest each one of the listeners to qualify the report, maybe by using these words or adapted words. So challenge could be there because generally clients may not be getting convinced with this version of guidance note because they may always say that this is the guidance note mandatory upon you, not us. Why to burden us? But yes, we have to, come out with a balance of convenience position. So depending upon case to case, try to qualify so that each one is safeguarded. So this is it from my side. If you have any queries, you are most welcome to ask. And once you will get this clip, you will get some more ideas on the discussion. I have also written a book on this NCE, and many other books are there, which Vijayji already is aware. You may visit this website, collectmybook.in, and you may have a look on this book. And this book is a comprehensive coverage of all these things, which I covered, with some sample reporting and other things. So I will be sending this PPT to Vijayji after closure of this session. And should you have any queries, I would be more than happy to answer in the chat box. Thank you, Sagar, for the compliment. There's a question by Vijayji. We have not made tax provision in the previous year. Instead, we have taken it to capital account. So how we present this in comparative? So in that very case, Khatri, what you will do, you will change this accounting treatment this year and you may route it to P&L. So the things will be corrected automatically. There's a question by Vishal Bhojwani ji. If we show audit fee payable under trade payable, then the auditor firm will fall under MSME and the payment is not made within 4 days. So will it be disallowed always? But as we made provision on 31st March, but audit is of September. So Vishal Bhojwani ji, first of all, irrespective of whether you show the audit fees payable in trade payable or not, MSME criteria will not be getting impacted because that is what MSME Act says. Now, the question is, if there's a delay in payment of audit fees to such audit firm, then we need to check whether it is a provision or whether it is a payable. If it is a provision, that means invoice has not been raised. But if invoice has been raised, then obviously it will be a disallowance because the payment has been delayed. So thank you people for the compliments. I'm really glad, and I must give this whole credit to the association who invited me, and especially Vijay Keval Ramani ji who gave me this opportunity. There's a question by Anurag ji. Should we put cost of direct services under cost of goods sold in case of service industry? Yes, Anurag ji, you can. There is no problem. There is a question by someone, can we remove notes which are not relevant? Yes, you can, as I already covered. There is a clause in the guidance note itself, excessive details need not be given. So that way you can use it and remove it. I'm stopping my screen share. I hope you must have seen this website and the book, and you may be availing this book. I hope so. Vijayji, I'm stopping screen share. If you have any more queries, I would be happy to answer.
Yeah, I request Vijay Bhai to take up the queries if there are on YouTube.
Yeah. No query on YouTube, we have already taken. Thank you, Kamalji, for accepting my invite in a single request and coming and guiding us about all this. I'm sure everybody has enjoyed it. If still you have any questions, please, you can raise your hand. I will unmute you. We'll take 2 to 5 questions before proceeding for the vote of thanks. You can raise your hands. We can take it up, or you can still put up on the chat. Kamalji has been responding on the chat also. So
I can see so much of thank you on the chat box, and really glad for this
it
overwhelming
was
response.
really an exciting session, Kamalji.
There is a question
Yeah.
by Prashant ji. Let me read this question by Prashant ji. If the report is qualified, then would it be still a matter of professional misconduct? Prashant ji, if the report is qualified for right reasons, then there will be no question of professional misconduct. So I must also emphasize qualification must be for right reasons. So each qualification by default is not a safeguard or a navy boat. That we need to understand.
So before I think the questions have been taken care. Before moving ahead, I, on behalf of tax friends, would like to present a certificate of appreciation to Kamalji for this wonderful session. I think, is it visible? Yeah. I hope the certificate is visible. Tax Friends Association Mumbai presents certificate of appreciation to CA Kamal Garg for enlightening the members on the topic financial statements of non-corporate entities at the study circle meeting on Zoom platform on 19th of May 2025 signed by CA Haridudani President and CA Manoj Dodeja Honorary Secretary. Kamalji, this will be sent to you immediately after the
Thank
meeting.
you, sir. Thank you very much, sir.
Yeah. And friends, Hari has asked me to say a few words about our association. Tax Friends Association is a 48-year-old association. It was started in 79 by a group of people to bring in close friends. And now slowly we have grown up. We have a YouTube channel which has more than 200 videos. We have conducted online conferences. We have conducted online certificate courses on IAS, INDS, and we have also done tally courses and various webinars. More than 200 webinars are there on our YouTube. We have a Facebook channel, and we have been doing as far as possible. We have a full-fledged managing committee. We are a Section 8 company, and we do study circle meetings every 2 months normally. And one feature is the annual budget meeting by some of the renowned speakers that we have. So this is a brief about tax friends. Hari, back to you.
Thank you. Thank you, Vijay Bhai, for nice introduction. And thank you, Kamalji. Now I request CA Amit Otwani for formal vote of thanks to our speaker.
Hope I'm audible.
Yes.
Yes. Thank you. Thank you so much for this lovely opportunity, tax friends. Special thanks to Hari sir and Vijay sir for this opportunity. Well, first of all, I would like to thank tax friends for organizing this topic in a webinar. Which is a very need of an hour. Thank you so much, tax friends. Well, very few webinars we see interactive. Very few webinars we see interactive. And one of such seminar we can see today, wherein each and every participant was replying to the doubts, I would say the doubts raised by the Kamal sir while delivering this webinar, and he has solved all these doubts by giving all the replies and answers to all these doubts raised by him, and which I really appreciate the way he has delivered the lecture. It was really wonderful, and this cleared our all the doubts and even the minute things which we had in our mind before this seminar, before this webinar rather. Thank you so much, Kamal sir. Thank you, sir, for the lovely session. I request everyone to please acknowledge and send the emojis to sir since this is a webinar. Well, I also thank all the participants, those who are actively involved in this seminar. Thank you so much, all the participants on the YouTube, on the Zoom, and all the online sessions. Thank you so much. I also request the tax friends. I also request the tax friends to please do arrange all such type of seminars and very good speakers like Kamal sir. Thank you so much.
Kamalji, there are two questions. If you can just respond to them also before we move ahead.
Okay, sir, can you tell me what questions are there?
Yeah, yes, sir.
There's a question by Vishal ji. Electricity bill will be classified under payables or provision. So Vishal ji, I will take this way. If you have received the bill for the month of March in the month of April, then it will be considered as payable because it is an event occurring after balance sheet date. But if bill is not available and you are not having the proper idea, exact idea as to what the amount shall be, then it will be a provision because provision is an estimate. Payable is the contractual amount. So depending upon case to case, you have to check. Then the question, can we change format of notes to accounts relating to owner's fund? So you can change the format to the extent it is not applicable. Otherwise, you have to keep the line items in the same way. So total change is not warranted by the guidance note, but yes, you can adapt as per the requirement.
Thank you. And friends, we had a full audience. We had a full house at one point of time here and on YouTube. So totally we had more than 200 people attending. Kamalji, your session was very informative and people have enjoyed. Those who need the PPT can write to taxfriendsindia@gmail.com. We will share you the PPT and membership queries can also be sent to that Gmail account. Thank you. I think
Thank you,
Hari
Vijay
will
bhai.
adjourn the meeting and
Yeah.